Welcome to this technical economic analysis on the construction of large-scale photovoltaic plants, what we commonly refer to as utility-scale projects. This video focuses on the trends observed over the last 6 months through May 2025 and is specifically aimed at technical and strategic professionals in the sector, from design engineers, EPC specialists, and project managers to developers, O&M operators, and investment funds that make decisions based on returns on investment and CAPEX. The objective will be twofold. On the one hand, to conduct a detailed indicative diagnosis of current construction costs, from modules to SCADA, incorporating analysis of the different power capacities of photovoltaic plants. On the other hand, to offer a strategic vision on how to optimize profitability and reduce technical and financial risks in the current context of inflation, regulatory changes, and logistical pressure. As you know, the utility-scale segment is currently the backbone of global solar growth. We're talking about plants over 50 MWp, although in this presentation, we'll also cover higher ranges of 100 to 500 MWp, where scale factors, detailed engineering, and proper EPC execution define margins in the millions. At these scales, a deviation of just €0. 0.1 WP in CAPEX can have a direct impact on investment of between €500,000 and €1 million. The image in the background clearly illustrates the type of assets we're referring to: a solar plant installed on a desert surface with a modular structure perfectly segmented into fields, maintenance roads, and row layout to maximize direct radiation. This type of plant requires a balance between technology, logistics, construction time, and supplier reliability. Over the next few minutes, we'll break down the critical components of these facilities one by one: market evolution, CAPEX, manufacturers, construction times, critical labor, financial analysis by region, and most importantly, current risks and their mitigation strategies. If you're part of a team that designs, promotes, or evaluates these types of projects, this analysis will provide you with a very precise roadmap for the next 12-18 months. Before going into the technical details, let's contextualize the scope and objectives of the report. This slide presents the general structure of the analysis and, above all, helps us understand who it is aimed at, what it aims to address, and the time and geographic framework we are working within. The report is composed of 12 thematic sections that follow a very clear logic, which we will review in different videos. We begin with a macro overview, market evolution, point 3, then move to the micro, costs, schedules, and labor. Midway through the report, point 7, the key suppliers and technologies for 2025 are introduced. We close with a risk section, and finally, conclusions and recommendations, point 12, which are not generic but strategic and actionable. This sequence allows us to study the general diagnosis until concrete decisions are made regarding investment and project execution. These videos are aimed at technical and strategic professionals, design engineers, who will find useful details about substations, trackers, SCADA, or modules. Project managers and EPC specialists. Key to coordinating execution times and costs by scale. Developers and investment funds, who seek clear signals on LCOE, return, and risk. O&M and after sales, who need realistic data on technology availability and long-term performance. It is essential that we keep in mind the analysis framework. We focus on plants over 50 MWp, that is, truly utility-scale projects. The data primarily covers Europe and Latin America, markets with strong regulatory similarities, but different in terms of solar resources, logistics, and labor availability. The period analyzed is the last 6 months, ensuring up-to-date information. In addition, scenarios are projected for 2025-2026, which are very useful for expansion plans or medium-term investment decisions. This report is presented with 4 objectives that will also be the pillars of these videos. 1. Analyze real cost and price trends, broken down by component and scale. 2. Identify critical profitability factors, from irradiance and logistics to financial risk. 3. Evaluate the impact of plant capacity, we will see that moving from 50 to 250 MWP not only implies savings, but also access to new execution strategies. 4. Propose strategic recommendations, ranging from electrical redesigns to reserves of critical materials or PPA merchant combinations. With this clear roadmap, we are ready to dive into the evolution of the solar market and see how the main drivers have performed over the last 6 months. Let's get into the evolution of the utility-scale market over the last 6 months. Here's a summary of the main factors that have influenced costs, delivery times, and new developments globally. The first thing that stands out is a significant price reduction: photovoltaic modules, down 18%, especially in bifacial and TopCon technologies, whose efficiency exceeded 24.5%. Inverters, down 12%, due to the normalization of semiconductor supplies. Structural, down more moderately, 8%, but affected by the price of steel and logistics. This has had a direct impact on CAPEX, as we will see later. Despite this price drop, logistics has put pressure on time and margins. Delays of 4 to 6 weeks have been recorded between Asia and Europe. Transportation costs have increased by 22%, affecting project execution forecasts. European ports are experiencing ongoing disruptions, which has driven a clear trend: local or nearby manufacturing to mitigate risks. On the other hand, the large-scale segment is consolidating. In Europe, 35% of new projects exceed 100 MWP. In Latin America, this figure rises to 48%, led by Brazil and Chile. This marks a turning point. The market is no longer dominated by small distributed wind farms and is focusing on large assets with economies of scale. We are also seeing greater consolidation among mid-sized developers who are now capable of building 200 or even 300 MWP plants. Globally, installed capacity reaches 186 gigawatts, with 42 gigawatts of new projects in Europe and 27 gigawatts in Latin America. Year-on-year growth is plus 42%, confirming that the utility-scale segment continues to accelerate despite economic and regulatory volatility. The graph below shows the regional distribution in recent quarters and the forecast for 2024. Asia-Pacific remains the absolute leader in installed and projected capacity. Europe and North America show sustained growth, with peaks in Q4. Latin America accelerates its growth and consolidates above the 25 gigawatts projected for Q4 2024. The upward trend in all markets speaks to an energy transition that continues to advance strongly. This market evolution creates a very favorable environment for the development of large-scale plants, but also requires a rethinking of timing, logistics contracts, and supply chain management. Now, let's analyze the updated CAPEX structure for solar plants over 50 megawatts peak, with data closing in May 2025. This information is key not only for designers and engineers, but also for developers, CFOs, and investment managers who need to make decisions based on cost per installed watt peak. The graph on the left shows how the total cost is distributed by component. Photovoltaic modules represent 40% of total CAPEX, being the most determining component. Structure and assembly, 15%, especially dependent on the price of steel and logistics. Inverters, plus transformer hubs and substations and connection, each contributes 2%. Civil works and roads, 10%, heavily influenced by topography. Engineering and permitting, 6%, and SCADA and systems, 5%. Complete the breakdown. Overall, this gives us an average CAPEX of €0, 42 WP, which represents a considerable improvement over the previous year. Let's now look at the comparative table on the right, which shows how prices per component have evolved in Euro WP modules, down 15% from 20 cents to €0, 17 WP. This is the most significant reduction. SCADA and systems, surprisingly down 18.2%, thanks to the standardization of solutions. All components show decreases of between 8 and 11%. Total CAPEX is down from 49 cents to €0, 43 WP, an overall decrease of 12.2% compared to 2024. This is in line with the downward price trend we saw in the previous slide and highlights the impact of production efficiency. What is enabling this sustained cost reduction? Technological advances, especially in the production efficiency of TopCon and HJT modules. Smart trackers and structures. Increasingly optimized for wind and energy efficiency. Supply chains stabilized after the post-pandemic logistics crisis. Economies of scale, which, as we'll see in another video, are critical in projects over 250 MWP. All of this leads to a cumulative reduction that significantly improves the viability of large plants in markets with tight PPAs. As you can see, this CAPEX reduction is not uniform but strategic. It is achieved through standardization, digitalization, and smart design decisions. In the next video, we'll analyze how these costs vary depending on the size of the photovoltaic plant and what advantages each power range offers.